Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. With just an hour to go until the closing bell. And right now, stocks, they are higher. Let's look at the popular averages. The Dow's up about 400 points. Your broad gauge, the S&P 500 is up about 0.2%. And your tech-heavy NASDAQ, it's also green, up about 0.1% here. Let's welcome in Al Root, Associate Editor at Barron's. We've got our Data and Markets Editor, Jared Blickery, joining us to help break down the headlines. We're going to kick it off to you, Jared, for a check-in on the trading action so far.
Yes, we are seeing another bullish reaction here. The Dow is leading the major indices. You can see it's up 400 points, 0.9%, and it's playing a little bit of game of catch-up this week because it was underperforming the NASDAQ and the S&P 500. You can see here it gapped up on the open. It started above yesterday's close, and it has maintained those highs well into the current hour here. Taking a look at the NASDAQ, just barely green there, not much of a story, but it had been leading earlier this week. S&P 500 adding a meager 0.2%, but all three of these indices up about 2% on the week. But what's really knocking it out of the park are the small caps this week. You can see it's up 1.5% today. Here is your 4-day total, 4.65%. Most of that coming in the last 2 days after that big CPI report yesterday. And I got to bring that up because we are seeing the opposite reaction in the bond market today than we are yesterday. It is heading down. That is the 10-year T-note yield is down 5 basis points to 4.24%. The 30-year is down 6 basis points to 4.83%, giving back and more so those gains that we saw yesterday. So here's the U.S. dollar index. That is also down again today. And we will skip over to the sector action. We only see a few sectors in the red. Some of them are defensive, so not a big concern here. That would be utilities and staples leading to the downside. Even utilities there, the worst off in the group is only down about 0.2%. What's flying high is materials. That's XLB up 1.41% right now, followed by healthcare, consumer discretionary, communication services, and those top three there, those are up by more than 1%. And what you're going to notice in the NASDAQ 100 is we're not seeing a lot of participation in some of the biggest stocks. You are seeing Apple and Amazon up more than 1%, but here we have Broadcom off about 1.5%, Microsoft over 1%, Meta down over 1% as well. So some of the leaders in here are some of those software and tech names like AMD. That's up 5.5%. I'll switch over to our semiconductor screen where you discount some of the bigger names. You are seeing more green than red there. Micron's an exception, down 3%. But I've been kind of going over the discrepancies and the different behavior between software and chip stocks. And we're not necessarily seeing that today. We're seeing a lot of green in the software stocks. So more cooperation in tech here, not the theme of the day. I'm going to leave us on the Dow. And here we see, aside from the big ones that we've already been talking about, Home Depot up 2%, United Health up 3.7%, IBM up 2%, had been sliding for a few days. And just overall, we're seeing sector rotation here. You're not always seeing it in the major indices, but you pop open the hood here. We are seeing different pockets of strength on different days, and that is the lifeblood of a bull market.
And Al, I'll bring you here as well, my friend. What are you watching in today's trade?
Well, I think Jared pointed out it's a day for rotation, right? So healthcare, one of the worst performing sectors of the year, United getting a bounce, helping the Dow maybe reach a record high. And then the strongest performers, those industrials and utilities, very strong performers year to date, caught up in the AI trade. They're probably more correlated with NVIDIA than the state of the U.S. industrial economy these days. So a little bit of rotation, but I think we'll probably end up at more record highs, which we do every day. So it's just another good day.
You mentioned the AI trade. Do you look at that Q2 earnings season? Mm-hmm. You listen to a lot of reports. You've listened to a lot of conference calls, Al, the CEOs and the CFOs of these AI companies. Do you look at that, Al, and I'm just curious what your big takeaway is. Does that mega AI trade and trend, does it feel intact to you, Al?
Yes. I think that bull markets always climb a wall of worry. Everybody's comparing this to the dot-com era. We're not at 1999 yet, I don't think. If we're talking about third inning, second inning, fourth inning, we're still, Google's, Amazon's, Alphabet, are still spending tens of billions of dollars on NVIDIA chips. NVIDIA stock is $4 trillion this quarter, or in the last few months, the first stock to hit $4 trillion. So we're not really at the peak yet. Will someday this end, and we'll figure out what happens on the other side of this cycle. But AI drives the market, and really isn't that convincing a case to be made that it's over.
Jared, let me go to you. I'm curious to get your take, Jared. I mean, you have, as Al was saying, and listen, another day in the green, the melt up continues. The question, of course, one question, Jared, would be, can the momentum continue? I'll tell you, Jared, I have had a few strategists come on the show, and maybe they do sound a bit cautious here. And no surprise, Jared, you ask them why the caution, why they're getting a little uncertain and hesitant. They'll bring up valuation, which is totally fair. But of course, the other side, Jared, is folks will say, listen, you can have a richly valued market that can keep right on trucking higher.
Yeah, valuation does not matter in the short term. Over the long term, it does. But one of the things that concerns me, and I haven't even really talked about this yet, maybe we'll get a chance to later in the show, is the Treasury is building its account up at the Fed by $400 billion over the next 8 weeks. That's going to suck out a lot of money that would have otherwise been in the markets. If they do that on schedule, as they have stated, that could cause a little bit of turbulence in the markets. But aside from that, I mean, we're just coming off two of the strongest, two of the biggest reports in the market. That would be the jobs report last Friday, CPI report yesterday. It's not a Fed day, but those two reports, the market climbed higher, net higher in the days after. So I'm not too worried about some of the macro fundamentals, not too worried about some of the valuation. Liquidity is my theme here, but that gets back to the Treasury, and that's an unknown at this point.
All right, thank you, Jared. Appreciate it. Al, you are, of course, sticking around with me. Meanwhile, all eyes on crypto exchange operator Bullish today. It more than doubled its IPO pricing in its debut, opening at $90 a share. Shares surging over 120%. And we're just below that $90 level now. For more, I want to bring in here Ed Engel, Compass Point Research and Trading Senior Analyst. Ed, it is great to have you on the show. Maybe start high level, Ed. I'm just curious how you think about Bullish, Ed, and its role in the broader market here.
Yeah, absolutely. And thanks for having me on. So I would say Bullish is an international crypto exchange. So similar to Coinbase, they offer buying and sellings of different digital assets. They also operate and own some media assets such as CoinDesk and also provide information services. And I think the big difference there is these guys mostly focus on markets outside the US. And I think one of the big opportunities for them is to maybe get into the US where competition is a little bit less intense domestically than it is in some of these international markets.
And it sounds, Ed, like their focus is also, listen, they're very focused on serving institutions, Ed. How excited, generally, would you say, enthusiastic are institutions about this space? I mean, we know retail investors, plenty excited, but how would you gauge the excitement of institutions?
Yeah, I mean, we could even argue that retail penetration in the US is actually decently high, where during last bull market, millions of people signed up for either Coinbase accounts or Kraken accounts, where that actually got penetrated fairly quickly. On the institutional side, we can probably argue that there's a lot more runway for growth, just given that historically institutions did not have access to these crypto exchanges. And so that probably does differentiate a Bullish a little bit more from a Coinbase, where Coinbase historically does kind of focus more on that retail user, while Bullish is a bit more on that institutional, whether it's a market maker or algorithmic trader. So
Ed, for investors listening, how big is the ultimate opportunity here for a company like Bullish? Can we try and put some numbers on it, quantify it?
Yeah, I mean, again, in the institutional market, also the pricing is going to be much, much lower. So the take rate that these exchanges earn on institutional trade is going to be fractions of what they are in retail. And then alternatively, on the international markets, these are much, much more competitive. You're competing with companies like Binance, OKX, Binance, and what you see is the fee rates in these international markets are razor thin versus what we see in the US. And I think that's one thing that Bullish has done a good job at, is they've still been able to grow while kind of competing on pricing. So it'll be interesting if they can kind of maintain that lowest cost provider aspect within the U.S. Ed, if they can get in the U.S.
This theme, Ed, we see, I mean, more crypto-focused names making their public debuts. I mean, so it's Bullish, it's eToro, it's Circle, it's Galaxy on the NASDAQ. Do you expect more to come, Ed?
Yeah, absolutely. Again, there's a ton of pent up demand, especially from the equity markets for these types of companies. So historically, equity investors weren't able to get exposure to crypto companies. And alternatively, it was really just retail traders that could get access to these crypto exchanges. And I think what's different about this cycle is you're just seeing a lot more companies, whether they're newly listed companies like Circle and Bullish, or even these emerging crypto treasury companies, where it just shows you that there's tons of demand from both retail and institutions for these types of companies.
I got
in the coming months, I'll add there's going to be a number of companies have publicly are confidentially filed for IPO. So we have Bullish that just came out, but a number of other companies have also confidentially filed, and we're expecting those to kind of come out over the next couple months.
Ed, I have to ask you, we were just showing the response to Bullish there. When you see that response, whether it's Bullish or to Circle, Ed, does it seem kind of frothy to you, Ed? Does it seem kind of, I don't know, SPAC-like, or no, these responses we're seeing, they seem reasonable to you?
Yeah, I mean, look, these are, for Bullish and Circle, these are IPOs rather than SPACs. So I think just a lot more, honestly, investor protection on some of these more IPOs, while historically the SPAC boom did get a little bit crazy in terms of probably not the same protections and rules that an IPO would have. But I mean, I think some of your points are valid. We've seen a lot of demand for these crypto treasury stocks, and volumes on those have been extremely high. And if you look at the valuations for a lot of these companies, we're actually a lot, we're definitely extended versus where we're historically. And so I think if there is a scenario where some of this does cool down, you can make the case that some of these crypto companies probably do have a bit more of an extended valuation. Is that why, Ed, we just showed there you got a sell slapped on Circle. You don't have many sells, but that's one of them. Is that why it is a valuation call? Yeah, I mean, we also have a sell on Coinbase, and I think our view for Circle is, look, this is a terrific company. They've got a great moat within their area of stable coins, especially in areas like DeFi and crypto exchanges. That being said, the stock's trading at over 80 times next year's EBITDA, which is a wide premium to some of these other crypto companies. And so I think it's a combination of, yes, valuations for that one, and as well as Coinbase does feel a little bit extended here. And then just meanwhile, just as institutions start to embrace digital assets more, I think it's still to be seen how much the incumbent financial companies have a say in this space. So whether it's companies like Stripe or JP Morgan or Bank of America, if these companies start to enter the blockchain industry and offer their own stable coins or crypto trading capabilities, it does kind of make us wonder how much of a moat some of the larger crypto companies today have. I want to end here, Ed, on some comments. I did hear from execs at Bullish today. They said they were taking the proceeds in stablecoin, Ed, which I thought was interesting. What do you make of that? Yeah, again, I have not had a chance to talk to management, so I'm a little bit behind on you there. But I mean, I think they have some plans to invest that into Solana ecosystem and maybe help that Solana ecosystem get more liquidity. But I think that's going to be a very nuanced opportunity for them. All right, look at that pop today in Bullish, showing it there. Ed, thanks so much for your time. Appreciate it. Great, thanks for having me on. In Washington, President Trump signaling he may be a little closer to picking a new Fed chair. Let's get to our Fed correspondent, Jen Schonberger, with the latest details. Jen.
Hey, Josh. Just hours after a report said the Trump administration was considering a pool of up to 11 different candidates to replace Fed Chair Jay Powell, President Trump said the pool for consideration is actually much smaller. Speaking with reporters earlier today, the president said he's down to 3 or 4 candidates, reaffirming comments he made last week. Take a listen.
I'll be naming a new chairman sometime within the next, I think I'll name it a little bit early, the new chairman. I'm down to 3 or 4 names, all good, all great.
Tuesday, Treasury Secretary Scott Bessent, who is leading the search and interview process for the next Fed chair, said the administration is casting a, quote, very wide net for candidates, telling the Fox Business Network that the president has a very open mind. Meanwhile, a report from CNBC this morning citing 2 administration officials said Trump is now weighing up to 11 different candidates to replace Powell, including Jefferies chief market strategist David Zervos and BlackRock chief investment officer for global fixed income Rick Ryder. But the White House debunked that. Deputy Press Secretary Kush Desai telling me in a statement earlier today, quote, unless it comes from President Trump himself, any discussion about personnel decisions should be regarded as pure speculation. Now, Josh, last week, the president seemed to imply that the two Kevins, that is former Fed Governor Kevin Warsh and Kevin Hassett, the director of the National Economic Council of Advisors, are on his short list, saying that the two Kevins are doing very well. When asked whether Fed Governor Chris Waller is under consideration, the president did not deny it. Josh?
And Jen, we're getting new info as well from Fed Presidents Goolsbee and Bostic. What is the latest there?
Yeah, so while the market is pricing in virtually a 99% chance of a rate cut in September, we heard from Chicago Fed President Austin Goolsbee and Atlanta Fed President Raphael Bostic, who are very much in a wait-and-see mode for the next 5 weeks before the Fed's meeting on September 17th. Goolsbee in particular seems to be eyeing inflation. He's concerned about the prospect of the impact of tariffs on inflation being more persistent, pointing to 50% tariffs on steel, for instance, and what impact that could have on intermediate goods, acting as a tax on manufacturers. He pointed to the recent CPI report, saying if we get more reports like that where we see the services side of inflation stickier and popping up, that would be a concern. Meanwhile, Bostic, who has been quite hawkish and felt that with the labor market in a healthy position, giving the Fed room to wait and see, is now looking at the job market, given that weaker than expected jobs report for the month of July, saying that it's the Fed's task over the next 5 weeks to see if the labor market is indeed signaling more weakness than previously thought.
All right, thank you, Jen. Appreciate it. We are just getting started here on Market Domination. Coming right up, we're learning more about new grocery options with Amazon. We'll tell you about the expansion and what that move is doing for the stock. Plus, we're watching oil prices take a tumble here. We'll explain the important reasons why. And stagflation fears may be rising as inflation and growth diverge. We're talking to an expert about what's on the horizon. Stay with us. That story and a whole lot more coming right up. Stocks are trading at all-time highs, adding to recent momentum following July's CPI report, which boosted odds of a September rate cut. But my next guest does see a risk in some of the data we're getting to here. Here with more is Scott Ladner, Horizon Chief Investment Officer. Scott, always great to see you, especially on set. Start with the markets here. Green again, everywhere, Scott. I got all the popular averages in the green. I got small caps joining the party. They're up about 1.6%. What do you make of this melt-up, Scott? What explains it in your opinion?
Well, I mean, I think we got some confirmatory evidence essentially that inflation is still kind of okay. That's helpful. That obviously opens the door to 25 in September and 50s on the table.
In other words, your point is that CPI report, investors looked at that and said, okay, there's no reason here that Powell wouldn't cut.
The last hurdle, right? I mean, like the last big hurdle, and we're going to get a couple more hurdles before we get there. There are more data to come out, but it's relatively clear. Like we have a weakening labor market and we have a stable inflation situation. It's not inflation is not where the Fed wants it, but the important part is it's not accelerating. Like we're not getting to the scary place where we're having this sort of ramp up back on inflation like we had in 22, where you just didn't know where the top was. Like you didn't know where the top was there, so you didn't know where the top was in the Fed funds. You didn't know where the top was in the 10-year. Like now, that's not where we are right now. We have an annoyingly sticky inflation situation that can be solved one of two ways. You solve it through a proper R recession, which we don't think we're going to get, or you solve it through some sort of productivity gains that you can get through AI, but it's going to take a little bit more time. So that second path is probably is a pretty good one for the market, though.
So, but you see, Scott, I know. So those are some reasons we moved higher. It's always a good time to take a deep breath and think about, okay, as investors, what are the risks I need to think about? On your wall of risks, what would those be, Scott? What would be the concerns you would flag?
Well, look, I mean, one you always have to flag with the current administration is just like some large-scale policy change that we just didn't see coming. Trump has obviously been sort of doing some meddling types of things on a micro level. I mean, in terms of like the AMD and NVIDIA 15% tax, telling Intel to fire their CEO, making fun of Solomon at Goldman, like all those things are sort of like nuisances, like they're on the micro level and they don't kind of rise to scale of being like important for the entire economy, or important sort of on the macro level. That's always on that card's in the deck though, like we know that, and so it's. That would be my chief risk, and unfortunately, it's not one that you can sort of forecast. You just sort of got to read and react. But that to us is like the big sort of boogeyman out there.
What about stagflation?
you might get some prints that look a little bit scary, but at the end of the day, like this is still a pretty strong economy with a consumer, especially in the middle and the top end, that's really strong and continue to drive stuff. I mean, you don't get stagflation with EPS growing 12% year over year, and with inflation, like again, sort of annoyingly sticky around 3%, but not accelerating higher.
What about, I'll bring you in, Al. If I was to ask you, I mean, listen, I have green everywhere again, right? We continue this melt up. On Al Root's wall of worry, your concerns, what would they be?
Tariffs, right? And tariffs feeding into that stagflation. The tariffs can, we keep talking about it, it's going to impact, we just keep kicking the can down the road. And China is the 800-pound gorilla in terms of trade and tariffs. We got another 90-day extension. So, it is an irritation for industries. We've talked about cars a lot, irritation for them, irritation for manufacturers buying steel and aluminum. But for the economy on the whole, it hasn't really showed up yet. So that goes in the unforeseen policy change category. I would completely agree with that. And then, we focus so much on tariffs. I would just worry more. I would focus almost solely on AI and productivity gains and how NVIDIA's doing. It sounds almost trite, but just see how Jensen's feeling. If he's still looking good, we're good. And if not, we got to reconsider valuations and everything else.
I will say, Scott, it's interesting Al brings up this point. I have heard people make this argument along the lines of what Al's saying here, which is, follow big tech. And if they seem solid and healthy and resilient, you stay long the market. I mean, is that too simplistic?
Not really. I mean, it's not too simple. I think that's about right because, think about what these guys are doing right now. They're doing like stimulus level, like economy stimulus level CapEx,
right? And
not getting punished for it. Usually, if you do like stimulus level capex, the market is going to absolutely punish you because of all the things that usually come about of that. They're being rewarded for that right now. This is more like when you're building the internet and like you had a company in 1997. If you weren't investing in the internet, you were gonna get creamed. If that's the sort of cycle we're going through right now, where like capex related to AI spending is seen as necessary and important, and that is a massive boost to productivity. It's a massive boost to the economy. So if these guys, if the big tech guys are continuing to do capex spending at this kind of scale, it is a huge stimulus boost, and it is telling you that like this cycle can continue on. Like these things don't go forever, but for right now, probably all right.
What do you make of that, Al? It was interesting. I mean, you'll have Zuckerberg come out, and the numbers he throws out are eye-popping, but then you'll have Meta bulls come on this show, and they'll say, listen, I see the ROI, they'll argue, on users and advertisers.
Yeah, we've seen this movie before. It's a cycle of spending, which is fine. And I'm actually I actually tend to be a bullish, market goes up 7 to 10 years, why we all worry so much. We're talking $400 billion of CapEx, up 30% year over year for sort of the big 4 or 5 AI players. One day we'll have to monetize that, right? You're going to have to earn an ROI on that. We'll worry about that in 27. So I don't mean to be trite, but it is wild. Like the market, Microsoft, Amazon's earnings, when they saw the CapEx numbers big and going up, they were, we can bid these stocks up again. It's sort of crazy. Take my free cash flow. I'm not worried about return yet. Just spend it. And this is the part of the cycle we're in. That's okay, but that's the part of the cycle.
Yeah, it's like know the game you're playing. Like this is the game we're playing right now. It doesn't go on forever, but it's important to understand the game, like sort of the rules of the game right now. And it is like ever more CapEx is a good thing.
Let's talk, Scott. I want to end here. I want to give some viewers some ideas. There are a few different ways to play the market. Let's talk about them. One is equal weight tech.
Yeah, look, we're talking a lot about the big boys, and you certainly need to have that in the portfolio. What I think is going to be a more interesting play, and probably like as we get into the fourth quarter and early next year, is we are going to get some sort of broadening out. People are going to have to start proving it. Like we're going to have to start using AI to actually drive productivity gains, and you'll see that in margins. Right, and you see that in margin expansion. So if we actually see some of these companies start to actually employ AI or kind of use this stuff in order to actually generate productivity gains, then I think you're going to see the AI trade sort of broaden out in a way more meaningful than we've seen so far. And I just don't know right now how to pick some of those early winners. And so with more of an equal weight tech sort of exposure, we'll just probably get at that sort of broadening out theme a little more efficiently without having to do some of the guesswork involved with like picking individual names for that sort of broadening out of AI.
Scott, great to see you, especially on set. Thank you, sir.
Thanks, Josh.
Now time for some of today's trending tickers. We are watching shares of Amazon, Apple, and Bloom Energy, starting with Amazon, which is expanding its position in the grocery delivery business by planning to double the number of cities it offers same-day delivery in by the end of the year. So this one was interesting, Al. So, all right, so same-day grocery deliver in 2,300 cities by the end of the year, Al. It sounds like we got free for Amazon Prime subscribers on orders over $25 in most cities. It's going to be about $13 in terms of the fee for non-members. Analysts do note, Al, I saw some folks saying, listen, this could pull some on-demand orders away, they were saying, from names like, they mentioned Walmart, they mentioned Kroger. What do you make of it?
You know what? Amazon is a little bit like bifurcated. It's an AI stock, but then, oh wait, they're a giant retailer. Mm-hmm. It's the Uberification, the Uber Eatsification of our entire economy. So people don't like to go outside, so this is a good thing. The stock's up 1%. What can you do?
What can you do? Team at Truist, by the way, they're fans of Amazon. Here's what they told their clients. They said, we view the move positively for Amazon, as they say it provides the company with another lever of growth in an under-penetrated market, should spur additional growth in the all-important everyday essentials category.
Yep. There
we go. All right, talking about another big name, Apple, working on growing its AI business, focusing on new products. It's according to a Bloomberg report. So this is coming from Bloomberg's Mark Gurman, planning new devices, Al. So we're talking robots. Mm-hmm. Apparently got a smart speaker with an AI, with a display, home security cameras. Bloomberg is citing sources familiar here. What do you make of it?
So, very broad picture. We're moving from AI chatbots into AI stuff. Embodied AI. Talk to Adam Jonas, read his reports. Cameras, robots, desktop robots, humanoid robots. To be a little bit pejorative, Apple just seems to see what Elon Musk said 2 years ago and then do it. Their self-driving electric car, Project Titan, that's sort of gone the way of the dodo. And so now we'll do humanoid robots. There's probably a dozen humanoid robots in the US that's being led by the likes of Tesla with their Optimus project that they want to start selling in 26. Apple, from that report, looking to sell humanoid robots in 28. So see what Elon Musk did, add 2 years, and that's Apple's strategy.
Yeah, does this actually happen? Do these products hit the shelves, Al? Who knows? We'll have to wait and see. Of course, it would actually depend too on, you'd have to stick the landing on the AI software, of course, when you're part of this.
Well, don't forget, Jensen at NVIDIA, says that robotics will be the largest industry in human history. So it's one of these cases of a lot of optimism, even from industry leaders, and things are improving, and then you just, like you say, you got to stick the landing.
All right, finally, let's end here on Centrus Energy stock. It's sinking after the company announced it will issue $650 million in convertible senior notes due 2032. So this is per Bloomberg News, which saw the terms of the deal, apparently, Al. They did only recently actually report results. That was earlier this month. Second quarter net income of about $29 million on around, it looks like $154 million of revenue. Stock is down today. We should know, big move this year, however.
Yeah, unbelievable. Last 12 months, we're still up like 400%. This is a nuclear play. Nuclear is a AI play. Don't forget when Amazon signed that deal with Talon Energy in 2024 for nuclear power to fund its AI-hungry data centers. All of those utility stocks, Constellation Energy, Talon, Vistra, they all went crazy. Cameco supplies uranium. This is a uranium supply play. Nuclear is a super hot area of the market. It's one of those picks and shovels play on AI that we were just chatting about. So again, when your stock is that high, you raise some money. This is a notes offering, and if you just look at the chart, you're like, oh, this stock is incredible. But again, it's sort of this nuclear narrative.
There you go. Down about 13%. Coming up after the break on market domination, what is affecting the oil market? Talk about that. Stick with us. Oil prices are lagging today. Stockpiles in the U.S. unexpectedly rose last week in a report from the International Energy Agency pointing out the risk of record world oil surpluses in the next year. For more, we're bringing in Yahoo Finance senior reporter Ed Engel.
Yeah, Josh, a gloomy report from the IEA that sent oil prices lower. And also we saw U.S. stockpiles unexpectedly rise last week. So that's why we saw pressure on oil, though it did settle off the lows of the session. But basically what this IEA report is saying is that the world is headed towards a record surplus next year as demand slows and supplies rise. And they are predicting that oil inventories are going to accumulate at a rate of 2.96 million barrels a day. That would surpass the average buildup during the pandemic in 2020. This is because OPEC Plus has been increasing supplies. And you also have strong output from the U.S., from Brazil, from Guyana on the supply side. And then you have waning demand on the other side. As far as U.S. inventories are concerned, those unexpectedly rose last week because of more domestic production, higher crude imports as well. That sent that number unexpectedly higher. But look, the bottom line is that Wall Street is expecting oil prices to be lower by the end of the year. You've got Goldman Sachs that's predicting that in the fourth quarter, Brent prices are going to be at $64 per barrel. That's around where they're at right now. And also, as far as 2026, they're expecting those to go even lower to $56 per barrel. There is the risk of an upside when it comes to these prices. And part of that has to do whether sanctions are put on Iran or sanctions are put on Russia. You did have President Trump today saying that there would be severe consequences for Russia if it didn't end the war after the summit that is going to take place tomorrow. But nonetheless, those are risks to the upside. But on the other flip side of this is just that increase in supply that is weighing on prices.
All right. Thank you, Inez.
Thank you.
Mediterranean food chain Cava reporting its second quarter earnings, disappointing investors by missing revenue and same-store sales growth expectations. Our Julie Hyman and Brooke DePalma spoke with Cava CEO Brett Schulman to break down the company's quarterly results and customer base.
Yeah, for us to Cava specifically, it was a combination of factors. We did have very significant challenging year-over-year comparisons. We launched steak, which was our most meaningful protein launch in a number of years, last year in the same quarter. So that did create a more pronounced lap of the comp. And then we also saw that our 2024 restaurant class, new restaurant class, opened at record levels, and when they entered the comp base, they didn't contribute what they typically do, given that they had opened at such elevated levels to begin with. Now, having said that, we do see what I would classify as a macroeconomic fog around the consumer that they're trying to navigate through. And that has the consumer less front-footed, less ebullient, less forward-leaning than they were, say, this time last year. And as we see, whether it's the budget bill and getting clarity on that, whether you like what's in the bill or not, at least you have a sense of what the future is going to look like. But then when the tariff policy shifts, that creates a little bit more density in that fog. So just trying to make sure we're putting a great everyday value out there for our guests so to help them navigate this situation.
What you were talking about lapping, not just steak, but those first-year restaurants that showed really strong growth. What are you sort of trying to put in place then to keep momentum going at those new locations?
Yeah, we want to focus on the long term, and our new class is tracking toward $3 million plus average unit volumes, which is higher than our existing AUV, around 2.9 million. So super encouraged by the strength that shows and the portability around the country, whether that's Plantation in Florida or Pittsburgh, we recently opened in Pennsylvania. And we want to be thoughtful about the long-term strength of this business. And so, for example, we have chicken shawarma launching in September. And we have a very good innovation cadence going forward, but we didn't want to rush chicken shawarma this year and perfectly align it to lap that steak comp from last year and potentially put too much pressure on operations. So excited to bring that in September. We've also got cinnamon sugar pita chips coming later this year. And we also noted that we're testing salmon in our market test of our innovation process that you can see on our menu next year. So putting that consistent pulse of innovation from the culinary standpoint. And then we just continue to see these macro tailwinds for Mediterranean as a category, that unique cuisine where taste and health unites, the growing appreciation for it, as evidenced by when we open in all these markets around the country, the increasing AUVs we're seeing in elevated levels of the openings.
Now you're in both urban and suburban markets, and particularly we got some new data out that showed that New York City office workers are returning to work compared to pre-COVID. It's now up. But yet you're experiencing a bit of a slowdown. So are people just packing their lunches more, perhaps?
Well, that's what is actually encouraging to us, the underlying structural strength of the business. We did not see any specific weakness in a region. a market, urban versus suburban, or even an income cohort. We stratify our restaurants by the average household income in these markets, and our lowest income markets are actually performing the best on comp. So the fleet of restaurants is moving in unison, and as we lap those very significant hurdles in June, we saw them decelerate, but as we exited the quarter, we saw the fleet start to regain momentum and reaccelerate into the third quarter.
I do want to dive into that a bit more, because what are you seeing in the beginning of these Q3? Is that fog that surrounded the consumer slowly moving behind them?
Well, it remains to be seen, with the shifting tariff policies, but we did note our comp has reaccelerated over our Q2 level in the beginning of Q3. So encouraged by what we're seeing in the exit rate of the quarter.
Will you ever return to that double-digit sales growth that we saw?
Well, we're always working to continue to drive traffic over the long term. Again, we want to build this for the next 10 years and beyond, not the next 10 weeks.
I do want to hit on tariffs and the impact that it's having on your company. What are you seeing now with the current system that's in place?
Yeah, I'm super proud. I want to give a shout out to our supply chain team. They've been incredibly agile this year, really working on behalf of our guests to mitigate any of those cost pressures we're seeing. And when you put all the puts and takes together and the things we've been able to do to drive efficiency and economies of scale and sourcing, we've actually been able to mitigate that. We have not taken additional price since January, where we only took 1.7%. We've underpriced CPI by almost 900 basis points now in recent years. And we beat restaurant level margin and EBITDA in the quarter and EPS. So we've been able to drive that really strong bottom line profitability without having to raise menu prices.
I'm curious where on the menu you are seeing tariffs hit. Is it something like avocados or, where?
Olive oil?
Yeah.
Olive oil is one. We get our olive oil from Greece, or we do get some of our hormone antibiotic-free beef from Australia. And, those tariffs are well advertised on what has been enacted on those countries, as well as potentially basmati rice that we get overseas, but it's been a great rice crop. So that's helped offset some of that. So a lot of puts and takes there, but those are very high quality specific ingredients we're going to continue to source. Now, we do source a lot domestically. We do source the majority of our ingredients domestically, and we are a domestic manufacturer. We have 2 production facilities where we are vertically integrated, and we produce all of our dips and spreads and some of our dressing bases that allows us that efficiency, cost effectiveness, and consistency that we can pass along into savings for our guests.
Up next on Market Domination, we are breaking down artificial intelligence and its impact on investing. Stick with us. It's a conversation you don't want to miss. DWave Quantum reporting its second quarter earnings, sharing 42% rise in revenue, but a loss of 55 cents a share, down 45 cents from the year prior. Yahoo Finance's Julie Hyman spoke to DWave CEO Alan Baratz about the company's results and products.
There are a number of different approaches to developing quantum computers. Some of them will take longer to mature, some of them nearer term. At DWave, we provide what's called annealing quantum computers, and those are commercial today with companies like NTT Docomo or Ford Otosan or Pattison Food Group, all using us today to help benefit their businesses.
So for people who are interested in investing in something like quantum computing, what is the use case today for the computers that you're selling versus the next step and the step after that and the step after that?
Yeah. So I think about it in 3 phases: near term, medium term, long term. In the near term, there are a broad array of problems that we typically think of as business optimization problems. This can be anything from workforce scheduling to manufacturing plant floor optimization, even protein folding. And these problems can be addressed today with DWave's annealing quantum computers. And so the companies that I mentioned a minute ago are all using us for business optimization. In the medium term, I think that quantum is going to make a significant impact on AI and machine learning. Specifically, quantum computers are very fast and very energy efficient. And what this means is that all this rhetoric around AI requiring nuclear power plants and massive energy generation stations is likely not going to be required to anywhere near that level once quantum computers are a part of the training process.
But when is that?
I think that we may be able to get there within a year or 2.
Really?
This is medium term. We're not talking about long term. In fact, at DWave, we announced a few days ago a first step toward this by introducing an AI machine learning platform that developers can use to start investigating how to use quantum for large language model training. But we still have a ways to go on developing that technology and bringing a complete product to market. And then longer term, we're talking about almost unimaginable things like designer drugs, where we could develop a drug that would address just your specific set of ailments.
So, for people who are investing in stocks like yours and others, obviously you've seen crazy gains in the stock that are exponential. What do you think is still sort of the biggest misconception, or what kind of education do you have to do for investors and potential investors?
Well, there are quite a few different quantum computing companies that are pursuing different approaches to developing their systems. And so I think you really need to take a look at which of these companies are talking about delivering products 5 or 10 years from now, and which of them are delivering products in the near term. I'm very proud of the fact that we are delivering products today that are creating value. And so I think that that's a really good place to start. But there is huge long-term opportunity as well.
And I should mention the opportunity today. You guys have been growing a lot, but you're still relatively small in terms of the revenue that you bring through the door. And so how quickly do you expect that to ramp up? At some point, is there sort of a tipping point?
Yeah. So there are two components to our business model. One is a service-based component, what we call quantum compute as a service. And for commercial companies that really just care about leveraging quantum to get better solutions to their applications, quantum compute as a service is the ideal model. But it takes time to build a revenue base around that because it's a service-based business. It's a recurring revenue business. Goodness, more predictable revenue growth in the long term, but it takes time to build that base of revenue. We also sell systems. Now, we just started selling systems only about 6 months ago. We sold our first system to the Jülich Supercomputing Center in Germany. That is a very complementary model because it's to supercomputing centers, government labs, so not necessarily commercial.
Research-based.
More research-based, but it's near-term revenue recognition. As soon as we install and deliver the system, we recognize revenue up front. So I think the two will work together very well to allow us to build both near-term revenue more rapidly as well as that base of longer-term recurring revenue.
A high-stakes tech clash erupting this week as Elon Musk blasted Apple for allegedly tilting its app store in favor of OpenAI's ChatGPT. He's threatening antitrust action after claiming his own AI chatbot Grok was unfairly sidelined. Sam Altman accusing Musk of using his platform on X to manipulate visibility, and Musk called him a liar. Al, 2 men enter, 1 man leaves. Musk, Altman. So basically, Musk, if I'm paraphrasing, is saying, listen, you, Apple, you're giving preferential treatment to Sam and OpenAI. You're tilting the scales. And Sam then fires back on X and says, well, that's pretty high talk from you, Musk, since you manipulate X to benefit yourself and your companies. You can imagine how well that went over with Musk, by the way, of course.
So Musk feels about Altman maybe a little bit away the president feels about Jerome Powell. Musk was involved in OpenAI, and that relationship has deteriorated. There's a variety of angles.
This has also deteriorated. I think that's a fair, polite, diplomatic way to put it.
Yeah, I think that's fair. OpenAI worth roughly $300 billion in private markets. XAI, Musk's company, which now owns X, which was Twitter, very complicated, worth about $110 billion. So Musk is chasing the leader. So there's a little bit of sniping to try and gain an edge. Apple responded to Barron, said, hey, we do nothing of the sort. We just offer great products to our users, and the App Store is free and fair, and everything's fine. That's Apple's opinion, of course. But yeah, Musk really wants to chase down OpenAI, and this is part of this. It, of course, actually impacts Tesla investors because, think about last week, Tesla shut down its Dojo computer program. Musk has talked about Tesla taking a stake in XAI. That's sort of the next buzz amongst the Tesla retail investor base, closing that relationship gap between XAI and Tesla. So it's just a developing story. I would put this in the category of competitive. Musk wants an edge. He's going to do everything he can to get an edge in the App Store, make Grok, climb the scales versus OpenAI and ChatGPT, right? These are the chatbots that we use. Gemini will probably get in there and try to have something to say about antitrust. But this is the chatbot wars.
You could also, if you're trying to gain an edge on OpenAI, you could also, of course, Al, just make Grok that much better, more effective, and smarter. I mean, that would be another way to climb the rankings, I would imagine.
Oh, 100%. Now, there are, if you go on X, which might be a biased, there's all of these reports. Grok has passed, ChatGPT 3.0, but how does it compare to 4.0? And Gemini. So there are people who are smarter than me. There are many people smarter than me, Altman and Musk being two of them, that rank these models. So you're right. Absolutely. The training and the people that you hire to do this, that's going to determine who wins in the end. Just by the good old market, OpenAI is the leader and Musk is chasing. I mean, XAI has only been around for a couple of years now, which is sort of remarkable what he's been able to accomplish. So yeah, competition, will winnow out the winners and losers of chatbot races. But yeah, I wouldn't say that Musk isn't investing in XAI and just trying to win in an underhanded way, but I think he's taking advantage of every opportunity he gets.
You use any of these yourself? Grok guy, ChatGPT guy?
Well, actually, it's almost an enterprise issue. We are a Gemini shop at Barron's.
Yeah, there you go, Barron's. There you go. By Elon Musk posted next. Scam Altman lies as easily as he breathes out. Now that's a nickname.
Nicknames. Yep. Too Late Powell,
never go wrong.
Scam Altman.
Exactly. I want a Lipton nickname the next time you come.
All right.
Try to beat Scam Altman. I dare you. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.